Picture this. Wall Street's most powerful regulators are staring down the next major leap in finance, crypto ETFs that pay you rewards simply for holding them. Investors are lining up, billions are on the table, and yet, at the center of the storm, the U.S. Securities and Exchange Commission is raising a massive red flag. Why? Because this time, it isn't just about Bitcoin. It's about staking, a concept that could turn the world of investment upside down. What's at stake isn't just a new type of ETF, it's the rules of the game itself. Just a year ago, the idea of a Bitcoin ETF seemed like science fiction. Wall Street had wanted it, crypto evangelists had lobbied for it, but regulators pushed back, fearing fraud, manipulation, and the legal chaos of digital assets. But in January 2024, a breakthrough. The SEC finally approved 11-spot Bitcoin ETFs. Overnight, crypto was no longer a Wild West sideshow, it was a mainstream asset class. Investors rushed in. Inflows to U.S. Bitcoin ETFs soared past $9 billion in the following months. Suddenly, Bitcoin wasn't just something you bought on an app at midnight, it was a ticker on your brokerage account. This wasn't only about price charts, it was about legitimacy. But while Bitcoin grabbed the headlines, a deeper, more complex innovation was brewing beneath the surface: staking ETFs. If you've never heard of staking, you're not alone. Imagine if, beyond earning dividends or bond interest, you could help run the entire global financial network from your living room and get paid for it. In essence, staking is the backbone of modern proof-of-stake blockchains like Ethereum, Solana, and others. By pledging or staking your crypto, you become a validator of transactions. For your service, the blockchain pays you in freshly minted tokens. It's like getting shares in the network's success, a truly digital version of sweat equity. The idea of bringing this powerful mechanism to Wall Street has sparked a gold rush among ETF issuers. Firms like Rex Financial and Osprey funds are racing to launch staking ETFs, promising not just exposure to crypto's price, but to its intrinsic yield. The pitch? You can benefit from crypto's upside without the hassle of setting up digital wallets, managing private keys, or worrying about technical know-how. Just buy the ETF and let the experts do the rest. But here's the catch, and it's a big one. When Rex and Osprey submitted their registration statements to the SEC, the agency's legal eagles pounced. In a blunt letter, the SEC warned that these funds might not even qualify as ETFs under U.S. securities law. The agency worried that Rex and Osprey improperly filed their registration statement and that disclosures could be potentially misleading. At the heart of the matter, does staking income really count as investment return, like a stock dividend or a bond coupon? Greg Collett, general counsel at Rex, remains upbeat. We think we can satisfy the SEC on the investment company question, and we don't intend to launch the funds until we do that, he told Bloomberg. Meanwhile, Bloomberg ETF analyst James Seifert notes, even if the SEC doesn't allow this structure to list, we still believe the more straightforward attempts to allow staking in a U.S. ETF will ultimately be successful. It's a matter of when, not if. But optimism meets skepticism on the regulatory front. The SEC's cautious stance is rooted in decades of securities law dating back to the Investment Company Act of 1940, a legal fortress built to protect retail investors from the financial chicanery of the past. ETFs, to be listed, must jump through hoops: strict registration, transparency, custody of assets, and above all, honest and complete disclosures. Enter staking, and suddenly, the regulatory picture blurs. Staking rewards are a fundamentally different animal than traditional investment income. In a dividend-paying ETF, you know the company's performance, you see the cash flows. But staking income depends on the inner workings of decentralized networks, protocols, code updates, validator performance, slashing penalties. For most regulators, it's like trying to audit an alien civilization. Here's another twist. Everything about blockchains is decentralized. There's no CEO to call, no headquarters to visit. If something goes wrong, say, a hack, a software bug, or a network collapse, accountability belongs to a community, not a corporation. The SEC is deeply uneasy about how funds will secure, store, and report on these assets. Let's step back and look at just how high the stakes have become. Bitcoin hit a new all-time high of $111,980 in May 2025, a staggering vote of confidence despite ongoing regulatory wrangling. Gold ETFs, once seen as the bedrock of alternative investing, have seen major outflows as investors chase crypto's exponential returns. We're witnessing a tectonic shift in investor preferences. But can the legal infrastructure keep up with technical innovation? The SEC is still grappling with basic questions. Are staking rewards more like dividends, interest income, or something entirely new? How do you calculate the tax implications when the yield comes from validating blocks on a decentralized ledger? If an ETF's income comes not from company profits but from running blockchain code, does it still fit the definition of an investment company under U.S. law? Not even the experts agree. Alison Mangiero from the Crypto Council for Innovation argues, staking is a core part of how modern blockchains operate, not an investment contract. She urges regulators to see staking as technological infrastructure, not a financial product. But SEC Commissioner Caroline Crenshaw has critiqued the agency's inconsistent approach to classification, warning that past attempts to shoehorn new technology into old legal frameworks have only sowed confusion and risk. Meanwhile, the global context is evolving fast. European and Asian regulators are taking more flexible approaches to staking products, threatening to pull capital away from U.S. markets if American rulemaking remains paralyzed. Marcin Kazmierczak of Redstone predicts, the foundation is being laid for more comprehensive crypto regulation, with staking ETF approval becoming increasingly plausible by late 2025. Yet nothing about this transition is guaranteed. The SEC's Division of Corporation Finance continues to pore over the fine print of ETF business structures, even scrutinizing Rex's use of a C-Corp structure, an odd fit in the ETF universe. The agency is delaying decisions on multiple staking-related ETF applications, including those from industry giants Bitwise and Grayscale. The feeling across the market is palpable. Progress is happening, but the path is littered with regulatory landmines. And it's not just a U.S. issue. If the SEC drags its feet or throws up roadblocks, Wall Street may lose its early lead in the crypto industry. Investors, hungry for yield, are increasingly open to moving capital across borders. After all, if you can't get your staking returns from a US ETF, maybe a European or Singaporean product will do just fine. But let's return to the core of the issue, risk, and how investors are being protected. The SEC's concerns aren't just about legal technicalities. Staking exposes investors to risks that most ETF buyers have never faced. Imagine earning a steady yield for months, only to lose your entire stake due to a network failure or hacking event, or having your returns slashed because a validator, a piece of unseen code somewhere in the world, failed its duties. How does an ETF provide full, clear disclosure of these risks, and how can investors be sure the rewards outweigh the dangers? SEC Chair Gary Gensler, never one to mince words, continues to warn, Bitcoin remains a volatile asset and investors should be wary. If that's the tone on the world's best-known crypto, what does it mean for something as experimental as staking ETFs? Yet the market's appetite shows no sign of cooling. Rex, Osprey, and a growing field of competitors are in a race to be first to market. Bloomberg analyst Eric Balchunas sums it up. Rex lawyers say they can work it out. Issuers are pushing the envelope hard in an effort to get first to market. The stakes are as high as the potential profits. And then there's the million-dollar question. What happens if the SEC says no? Will the industry challenge the decision in court, as it did with the Grayscale Bitcoin Trust? Will Congress step in to update the legal framework, or will American investors simply get left behind in the next chapter of financial innovation? As the SEC's next move draws closer, everyone, investors, ETF issuers, crypto advocates, and regulators alike, are holding their breath. Is this the moment when the old guard of finance finally embraces the new world of crypto staking, or will the gates remain closed, at least for now? The answer could reshape not just the future of ETFs, but the very way we think about risk, return, and financial infrastructure. What will it take for staking ETFs to cross the regulatory finish line, and what happens if they never do? In the second half, we'll dive deep into the possible futures for staking ETFs, the likely responses from global competitors, and what this all means for anyone looking to profit, or just survive, in the next era of finance. As we rejoin our story, the fate of cryptocurrency staking ETFs in the United States hangs in the balance. Behind closed doors, SEC officials pore over dense legal filings, while innovators and investors anxiously await word that could transform, or stall, the next big wave in crypto finance. Let's dive into the possibilities that lie ahead, the wider global chessboard, and what all this means for you. Picture two parallel futures. In one, the SEC seizes this moment of innovation and charts a clear, forward-looking path. In the other, Regulatory gridlock prompts the world's capital and talent to migrate offshore, leaving the U.S. on the sidelines of a trillion-dollar revolution. Every major move in this unfolding drama ripples across markets, boardrooms, and even the screens of everyday investors. The optimistic future? Here, the SEC overcomes its hesitancy, publishing clear, comprehensive guidelines for staking ETFs. Instead of treating digital assets as oddities or threats, the agency adapts the Investment Company Act to embrace the nuances of blockchain validation and staking rewards. The definition of investment income is updated. Disclosures become a model of transparency, explaining, for example, risks like validator downtime or slashing in crisp, accessible language. Custody of digital assets shifts to fully insured, technologically advanced solutions. Surveillance and anti-manipulation systems are implemented robustly, echoing the rigor of the most scrutinized equity markets. In this world, staking ETFs surge from niche experiments to mainstream vehicles. Retail and institutional investors alike channel billions into products blending yield generation with blockchain exposure. ETF analyst James Seyfarth's words ring true. Even if the SEC doesn't allow this structure to list, we still believe the more straightforward attempts to allow staking in a U.S. ETF will ultimately be successful. The U.S. leads in product innovation, attracting global capital. Annual growth rates in staking-linked funds could hit 20, even 30%. The SEC finally delivers clarity, and U.S. markets thrive. But what if the SEC treads cautiously or draws the line before staking ETFs can blossom? In that scenario, legal ambiguities and risk-averse stances persist. The SEC continues to view staking income as too novel or too similar to an unregistered security. Applications stack up, each running into a wall of procedural delays and requests for more information. Clarity comes slowly, if at all. "We don't intend to launch the funds until we do that," says Rex's Greg Collett, reflecting the regulatory bottleneck innovators face. Meanwhile, other jurisdictions take note. Europe and Asia, already warming to crypto asset funds, move swiftly. Nations like Switzerland and Singapore issue their own staking ETPs, exchange-traded products, with clear legal standing. Investors hungry for yield and diversification migrate their capital eastward. The U.S., once the leader in ETF product development, suddenly finds itself in catch-up mode. This is not a remote possibility. We've already seen gold ETF investors shift focus. Outflows from gold ETFs in the U.S. have been mirrored by surging inflows into crypto ETFs elsewhere. A global rebalancing is underway, and regulatory momentum matters. And there's a third, more moderate path. Regulatory pace is cautious but not glacial. The SEC, perhaps under new leadership or through congressional action, gradually accepts the logic that staking is a technological function, not an exotic investment contract, as argued by Alison Mangiero from the Crypto Council for Innovation. Staking is a core part of how modern blockchains operate, not an investment contract. Incremental approvals follow. Maybe a pilot staking ETF is greenlit under strict conditions. Extra disclosures, a higher bar for custody, perhaps even a regulatory sandbox. Each success increases comfort and invites broader participation. Institutional inflows keep mounting. Recall that U.S. Bitcoin ETFs recently attracted over $9 billion, and that was before staking ETFs were on the table. Of course, the SEC's caution is not unfounded. Risks are real and multifaceted. Blockchain networks can and have suffered from validator attacks and protocol bugs. The challenge of slashing, where staked coins can be lost due to errors or malfeasance, is unique to proof-of-stake protocols. Market manipulation risks, from wash trading to coordinated attacks, loom larger here than in almost any other asset class. The infamous volatility of crypto assets has been repeatedly emphasized by SEC Chair Gary Gensler. Bitcoin remains a volatile asset and that investors should be wary. A major mishap, think a high-profile protocol breach or a coordinated market manipulation event connected to a staking ETF, could see the SEC slam the brakes hard, prompting an even more restrictive regulatory environment. Investor confidence would be shaken, and broader adoption set back for years. So, what does all this mean for you? First, recognize that we're standing at a once-in-a-generation inflection point in investment history. In just the past year, the U.S. SEC did what was once unthinkable: approve 11 spot Bitcoin ETFs. Bitcoin soared, hitting historic highs, $111,980 in May 2025, demonstrating the pent-up demand for mainstream crypto investing. The decisions now being made about staking ETFs will shape the future landscape just as profoundly. If you're an investor, pay close attention to regulatory developments, not just the headlines, but the fine print. ETF structures, disclosures, custody arrangements, and tax treatment of staking rewards are all details that could mean the difference between a safe, lucrative investment and unexpected risk. Subscribe to updates from your ETF provider and trusted analysts. For those eager for first-mover advantage, remember, innovation often comes with heightened volatility and regulatory risk. If you're a builder or crypto entrepreneur, there's a lesson in persistence and adaptability. The regulatory environment is evolving, sometimes messily, but it's moving. SEC Commissioner Caroline Crenshaw has publicly pressed her agency for greater consistency. Applying traditional frameworks to digital assets is hard, but the status quo cannot last. Her words signal an emerging willingness inside the agency to grapple with crypto on its own terms. Innovators who maintain compliance, transparent operations, and patient engagement may well become the next market leaders. And for policymakers and the broader public, this contest is about more than just one product. It's a referendum on whether the U.S. will remain a leader in financial innovation or watch as a new digital capital market is built elsewhere. So, to answer our opening question, will the SEC allow staking ETFs, and what happens if they say no? Based on all available signals, the SEC is unlikely to endorse the most aggressive novel structures immediately. They will likely delay, demand further study and disclosures, and possibly require new legislative input. However, progress is already visible. The regulatory tide is shifting. As Marcin Kazmierczak of Redstone predicts, staking ETF approval is becoming increasingly plausible by late 2025. It's a matter of when, not if. And if the SEC drags its heels, the gravitational pull of global innovation and capital could force its hand sooner than it would like. If approval comes, expect a true gold rush, not just in the form of new products, but also in the sophistication of investor protections, custody solutions, and, ultimately, the mainstreaming of decentralized finance. If the SEC refuses, the U.S. risks ceding one of the next great frontiers in finance to more agile competitors abroad. Either way, the genie is out of the bottle. There's a secret fact this entire debate obscures. Staking is not some exotic investment. In the world of modern blockchains, it's the engine that keeps the networks running, akin to dividends from stocks or interest from bonds, but democratized and automated by code, not corporate boardrooms. The regulatory frameworks will catch up, but in the meantime, understanding the basics of staking and the risks and rewards it brings could give you an edge no matter which way the winds blow. If you found value in this deep dive, don't just be a spectator. Subscribe for updates, comment your thoughts below, and let us know. Do you think the SEC should move fast?